This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today.
Our guest is Jim Pfeifer. Thanks for being on the show, Jim.
Thanks for having me, Whitney. Happy to be here.
Jim is one of the founders of Left Field Investors, a group dedicated to educating and assisting like-minded investors negotiate the nuances of the passive investing landscape and world of syndications. Jim is a former financial advisor who became frustrated with the one-path-fits-all approach of the standard financial services industry. Jim now concentrates on investing in real estate assets that produce cash flow and is committed to sharing his knowledge with others who are interested in learning a different way to grow wealth. Jim, thank you again for your time. I've known you for a while. It's grateful to have you on the show. So get us started, a little bit of your background. I know you had a financial advisory background, but then, was that real estate, or did you do any real estate then? What got you into real estate? Give us a little more context there.
Yeah, thank you. So I started in real estate accidentally, but I'm kind of on career number 4, I would say. I was in business for a while. I was a teacher for a while. I was a financial advisor for a while. And now I'm just an independent guy investing in passive syndications. But when I started, I call it an accidental landlord. We we bought a new house in 2008 and we couldn't sell our old one. So we rented it and did that for about 5 years. And I was the property manager and I did not like it. So I went to sell that house because I didn't like, having to go over Christmas Eve to fix a toilet, which did happen. And my realtor said, "Hey, why don't you let me manage it for you?" And so I said, okay. And so he did. And then he convinced me to buy 2 more properties. And I did. And I still own those properties and they're making money. That got me into real estate. And so I was the guy with shiny object syndrome. I went and bought turnkey investments. I bought a 22-unit multifamily building. We did a flip, and I joke because that flip made us hundreds of dollars. And if you know about flipping, you should make much more than that. So I was all over the place until I kind of found syndications when I was at a seminar because I thought I wanted to be a syndicator. I went to the seminar and I learned, no, I want to be the passive. I want to invest in other people's syndications. So I did, and I started out kind of investing my self-directed 401k in a bunch of different syndications that gave me a lot of lessons about what I don't want to do. And over the past 2 years, I've learned and I've focused, and now I know the kind of syndications I want to be in. And so now I'm much more focused and on the right path, I think.
Nice. It's just interesting to hear how people get to the syndication business for sure. If you say syndication to somebody new about investing, I mean, it's like, there's no clue what that is. And so it puts up this big wall a lot of times, but you dove in there, you learned about syndication, learned you wanted to be passive. And so Jim, let's dive in a little bit. How did you navigate the waters of just learning syndication? You said you invested with your IRA first. You learned a lot of what not to do. What were some of those things? So now, you've been more successful investing.
Yeah, well, originally, I don't want to get too technical, but I had a self-directed IRA, which, it doesn't really make sense to invest in leveraged investments in an IRA because you'll pay the UBIT tax, which is a tax inside your IRA. So, when I first got it, I had a bunch of money in a rollover, and I was super excited to get started. So basically, everybody I met at this syndication seminar, I'm like, I'll invest in your deal. I'll invest in your deal. And I wasn't really looking at the deals. I was just trying to get started. And while that's not the best strategy, I also think it's a good strategy sometimes to just take a chance, try something out, and see if it works. So that's what I did. And the investments aren't horrible investments. They're just investments that aren't paying out like they should or on time that they should. And I'm fortunate because that's in my retirement account. So that they're playing out slower than I thought, it doesn't really matter. But now I'm focused on real assets that produce net income for me, and that's what I'm living off of. So my strategy there has changed for sure.
Okay. Well, tell me though, so are you still focused on, using your IRA, or are you more, not too focused on using your IRA? Anything specifically that you could recommend about that process before we move on?
Yeah. So I converted my IRA to what is, I guess, called an EQRP, or a self-directed 401k. And that, for some reason, the tax code, you're allowed to have leveraged investments in that. but you still lose out on depreciation and other tax advantages of syndication. So right now in my self-directed qualified account, I'm only doing private lending or any kind of debt structures that don't have these tax advantages that you do have in the other, non-qualified accounts.
So let's hold off right there just for a minute. So like the EQRP, it's something that's kind of, maybe it's not new, I don't know, but it's new kind of to being known in the industry. I feel like to a lot of people, or you hear that term and it's like, well, what in the world is that? What would you advise now to the investor listening that's saying, oh, wait a minute, Jim, I've thought about using the EQRP, but I don't know if that's what I need to do or not.
Yeah, I would say that if you have a rollover or 401k that you can put under your own control, I don't think it matters if you do a self-directed IRA or an EQRP if you're just going to invest in or you're just going to do private lending or debt instruments, things like that, because that's what I think belongs in your retirement accounts rather than the syndications that give you all these tax benefits. So I would say it doesn't really matter which one you do, but you get the money in your control. You can still invest it however you want in the market or in real estate or whatever. If you really want to get into syndications and the only thing you have is your 401k, then I would definitely recommend the EQRP or solo 401k because those get you around the UBIT. And I would say it's better to have some real estate than none. So I would still be okay knowing that I'm going to miss out on depreciation, some of the other tax benefits, but at least I don't have the UBIT in the solo 401k.
So you would say, definitely transition it to an EQRP, if we have a 401k or something like that. So we have that checkbook control, but maybe use it for something other than syndications like hard money or something like that. Yeah.
And there's actually syndications you can do that are just lending, that are just debt. So I would find some of those or I run a couple of local real estate meetups and there's plenty of flippers and buy and hold people who I learned, once I get to you where I know, like, and trust you, then I can loan money to you. So I do that in just individual loans to people as well. And I do all of that through my retirement accounts because there's no tax benefit to doing it elsewhere.
Give us a couple of details on how you document something like that. So you're just handling that capital properly.
Well, that's, the first time I did it, I just took the other guy's wording and just signed the document. And it was somebody I trusted, so I don't have any regrets. But I just didn't want to spend lawyer fees. But now, on the new deal I did, also with somebody that I trust very much, I decided I need to get real documents that are vetted by my attorney. So either I pay for them, or in this case, I asked the lender, or the guy I was lending the money to, I said, part of this deal is you're going to have to pay for my attorney to do the documents. And he was fine with that. But even if he said no, I would have spent the few $100s it takes to have someone go through and check the documents. I didn't do that for the first few deals, but it's money well spent. I haven't had any problems, but I will always spend the couple $100s that I've avoided all this time to get the right documents.
All right. So changing gears just a little bit, Jim, since you're helping many other investors now, just open their eyes to the syndication business. And, how would you say, or what's the hardest part of teaching them, what the syndication business is? How do you expose them to that and share the great things about this model?
Yeah, that's a great question. I have a couple of different groups. One is the beginner group. And there are people who are friends or even a couple of former advising clients who've always told me, hey, I hear you're in real estate. I'd love to get into real estate. And they just might not have the capital to do a deal on their own. So with that group, we're just starting from scratch, educating all the way through. And we actually, in that group, through a company called TribeVest, where we invest our money together, we just invested in our first deal, our first syndication. There's 11 people in the group. None of them had ever done one before. We walked through it step by step. We talked to some different syndicators through, Zoom has been a blessing in that sense. And so we just went step by step and educated people on crowdfunding, syndications, the tax structure and everything, and went through the process. Then there's another group of people that are interested and know about syndications, but might be able to invest on their own because they have a little bit more capital. That group is kind of a little more advanced group. So we kind of just talk to each other. And I thought I would have all this knowledge to give and share with people. But I find that even when I'm talking to someone brand new, I learn something every single time. So the act of sharing my, what I call my syndication knowledge or experience or whatever you want to call it, it's just been given back to me, tenfold by talking to people that have a different perspective or don't really know about syndications. And I learn something every time. So I'm really surprised that happened and grateful for it.
Jim, before we started recording, you had mentioned, just like helping others and yourself just understand like real assets producing actual income versus paper speculation. And just wondering if you would highlight on that a little bit, and let's dive in there for a minute.
Yeah, certainly. I was a financial advisor, and, we were always, you're in the stock market or other products, and it was always these paper products that, at some point you're going to have to find somebody else to sell them to so you can make money. Now, there are some that, you can collect dividends off of some stocks, so there is that. But I'm a strong believer now in acquiring assets that provide you cash flow, because then you'll never have to worry about, you can quit your W-2 when you get enough, you can have retirement, all of this stuff, because these assets produce this cash flow. Well, also, if you're patient and on the back end, they also produce appreciation. But I never factor that into when I'm investing. I always think, okay, I'm just looking for the cash flow, because this is what this is how I'm paying for my lifestyle, my family, and all that stuff. So I want assets that produce regular cash flow. That's my main focus. Now, there may be a time when there's some, I'm focusing on appreciation a little bit, but my main focus is I want an asset that's going to produce cash. That's everything I'm doing right now is focused on that.
If you're paying too much in taxes and you want to recession-proof your investment portfolio while also avoiding those common pitfalls that many investors and syndicators fall into, you should attend Think Multifamily's annual Fire Summit Conference, November 11th and 12th. You can save $100 by using promo code Whitney100 when you go to thinkmultifamily.com/fire. Again, that's promo code Whitney100 to save $100.
Our guest is Sam Silverman. Sam has become really a professional passive investor. He has dove headfirst into this business and became that passive investor because of the income level that he had. He had to figure out what the best way to invest that was. And we're going to get into that today, but a little about him. He is a tech sales leader that has led global organizations. He's leveraged his day job into building wealth through both passive investing and operating multifamily apartments. But today we're going to get into how he graduates college and then has this income that he hasn't had before and has to figure out what to do with it, right? And he goes down that path that most of us have gone down or have thought about going down, which is, starting with single family homes, and learn the hard way how much brain damage or just time has to be spent to make that model work. But he took some big changes, learned a lot about passive investing, and now is becoming active in the space as well. So I hope you enjoyed the conversation. Welcome to the show, Sam. A pleasure to have you on as a guest. And tell us a little bit about your background. I want to hear, because I know you are a very active passive investor, but now some things are changing, and you're changing even how, from the passive role to more of an active role. And I want to get into that. But tell us a little bit about even your W-2 position and why invest in syndications.
Yeah. Well, Whitney, thanks for having me on here. Big listener of your podcast. So definitely appreciate coming on here. When looking at the W-2 job, so right out of college, got into sales. And when you look at sales, especially in tech, it's a pretty low barrier to entry job, right? Meaning that you can quickly scale and grow in the role, both in terms of position, responsibility, and more importantly, earnings. So when you look at that, you have the excess cash that you never had before, that you're looking to, what do I go do with this? Right. So that was kind of my entry to real estate, and started in real estate like a lot of people do. Bought, I think, 8 single family houses right out of college the first few years, and realized this was not the path that I wanted to go down. I think something people miss a lot when looking at single family is just the amount of mind share and headspace that it takes up. So
I call it brain damage.
Yeah. That's a nice way of putting it.
Yeah, I did the same thing, started just, and that's the way I was advised by so many people who had been in the business a very long time as well. It's like, you have to start small and eventually you'll get there, you'll grow, and you'll move from that single family to maybe a duplex and fourplex and eightplex and after a few years, but keep going. You bought 8 single family homes right out of college, but you figured out that, wait a minute, there's a lot of work involved here, a lot of time.
Yeah, so I was lucky in a sense when I bought them that I actually bought in a submarket of Jacksonville, Florida. So great market. I love the area, especially now multifamily as well. But that area, for context, I bought the first house on more or less farmland. Like they had to clear trees to even put the single house there. And now there's 30 or 40 houses within a few blocks. So the area, I probably caught it in the second inning. So it's moving on up probably third or fourth inning now. So being able to do a few refis on those properties, pull a lot of my cash back out of them, sold a few. So really good learning experience. I think it's actually similar to what I did at first in sales, right? As an SDR function, where if you look at that role is booking appointments, pass them off to more senior sales reps, and then kind of earning your stripes that way. So I view it as a really similar experience where it gives you the insight as, hey, what do you want to do? And what do you definitely not want to do? Which I think is a super important part. Like understanding what you don't want to do first really helps point you in the direction of what you actually want to do.
You need to get clear on those things, right? What you do not want to do. And tell us a little bit about what were those things for you and how was that helpful?
I think the biggest thing was when looking at the cash flow from the properties, right? Just kind of breaking down one property, for example, they'd make anywhere from $200 to $400 a month, right? And giving yourself some reserves. They weren't bad properties. Like it was solid cash flow. But the biggest thing was that each purchase was a new transaction, right? So when looking at it, it wasn't getting to scale to the point where, hey, I can now replace my entire W-2 income. This is a lot of freaking houses, right? You start running the math on them, and that is a lot of houses, a lot of transactions, really spread out property management as well. Even if you can get them somewhere close together, right? You're still paying a premium to have those units managed. And it's a lot of different transactions, a lot of tenants. I think one of the biggest things as well is that you have a single family house. Once it's vacant, you're netting zero on that property, which can kind of be a good pivot to the multifamily side where your break-even standpoint when looking at occupancy is so much lower than single family, right? 100 versus maybe 60, 70%. So huge swing when looking at that.
For sure. No doubt about it. You had this income, all of a sudden you get out of college, you're making some money. You said, you know what, I'm going to figure out what to do with this. You found real estate, you start buying single family homes, you figure out there's a lot of brain damage, or a lot of time spent, a lot of just time, mental time. I think you said, I mean, it's so true. So true. People don't realize, but you buy these homes and I love how you say, you need to know, what you don't want. And so you figure out what you do want. And so move us from there. Like, how did you buy more single family homes? What happened next? What made you then look for something other than, this business plan that you had?
So I took a step back and started with, okay, where do I want to get to? Because at first it was just go, right? Do something, right? Better than doing nothing, at least taking some action. But then once you kind of have the momentum, you can take a step back and think, okay, start with the end in mind of where you want to get to versus what you're doing on a daily basis just to push the ball forward a little bit. So from there, I looked at, okay, what is something that I can get involved in that allows me to spend almost all my focus on my day job, right? Being in sales and having a good career trajectory, your earnings are variable, right? Where if you perform better, you make more money. If you perform better, typically you're in a sales org. If you're in a good one, that's purely a meritocracy, right? It's not tenure based. It's not political, right? It is solely based on performance. And it's a very metric driven role, right? Wherein certain fields, say, for example, if you're a doctor, right? You may be a great doctor, but maybe hard to quantify how good of a doctor you are. You look at sales, it is black and white, right? Age, tenure, politics really don't matter, right? It's more so if you perform, you'll earn well and have a great path. If you don't, you'll likely be out of a job. So I think it was a really, really compelling area to get started in. So kind of looking at the switch that I made from single family, stopped buying single family, sold some off, still have a few that are actually performing pretty well. Long-term tenants there. So maybe once the units turn, I'll look at selling those. But for now, they're fine. So did a lot of research, right? From podcasts like yours, from Michael Blanc, he's awesome. His podcast, great educational content as well. And then what I started doing is just learning a lot more about multifamily syndication, where all these people go on to these podcasts to talk about a topic, but if we're being transparent here, it's to promote their business in some way. And you look at it, kind of my roles have been building sales orgs. And one of the biggest characteristics of building a good sales org is hiring the right people, So my background is really well versed in interviewing. So what I would do is I'd listen to, podcast after podcast after podcast, find people that I thought seemed genuine, transparent, competent, and then I'd get on a call with them and I'd interview them, right? As these are people you're giving a check of, $50,000 plus to, that you want to feel confident in who they are as a person. Character is a really big thing. All these deals you'll see, the differences in terms of returns are negligible, right? They really aren't a huge swing when looking at, 15% versus 17 versus 18 versus 16, right? It's all pretty standard. But the biggest thing that you want to see is that who is this person who gave my capital to? Like, we all know how hard it is to go make that money and actually save that to a point where you can go invest in a deal like this. And then more so, what's your confidence they can go execute on this business plan, and if they're realistic in their expectations, and provide themselves the proper buffers on either area.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.